Very good morning. Now we are going to discuss about the introduction about the insurance company accounts. It is insurance is a contract whereby it is insurance agree to compensate for a specific loss to the insured who in consideration agrees to pay a sum of money called premium. The insurance company agreed to pay the compensation known as the insurer, and the person who taking policy from the insurance company is known as the policy holder. Then insurance is a contract in which a sum of money is paid to the insured in consideration of insurers incurring the risk of paying a large sum upon a given consistency. In an Types of insurance, there are two types of insurance in general. First one is life insurance. Second one is general insurance. Life insurance, it is an contract between the insured and the insurance company, in which the insurance company agrees to pay the policy amount on the death of the insured or the maturity period, maturity of the policy, whichever is earlier. Because nowadays it is due to competitions, it is everybody, it is insurance is also considered one of the investment avenue nowadays. Hence the policyholders agrees to pay the amount is called as a premium. Then next one is general insurance. In insurance other than life insurance, all insurance contracts other than life insurance are considered the category of general insurance. For example, marine insurance, fire insurance, everything it is governed by General Insurance Act 1972. Then it is the difference between life insurance and general insurance. It is a contract of certainty. Here it is in general insurance, it is a contract of indemnity. In life insurance, it is a long-term contract. Here it is in general insurance, it is a 1 year contract. Because in a fire insurance or marine insurance, on a yearly basis, they have to renew their premium. Then in life insurance, it is governed by LIC Act. It is life insurance corporations. Here, general insurance, it is governed by General Insurance Corporation Act. And then it is life policy can be assigned to others. It cannot be assigned to others in general insurance, because in this, if the company is applied for fire insurance, if any losses is occurred during the certain period of time when the company cannot transfer their rights to other companies also. Then it compares of investment and protections. Then in general insurance, it consists of only the protections, no investments, because we cannot claim without any occurrences of the event. Then insurable amount must be exist at the time of proposal. Then in general insurance, it must be exist at the date of proposed at the end of the contract. The surrender value is possible in life insurance, then no surrender value is available in general insurance. Then the policy amount will be received in the event of death or maturity or the date whichever is earlier. Here in general insurance, the policy amount will be received in the event of risk or loss is occurred. Okay, in the next one is final accounts of life insurance companies. Life insurance companies final accounts. First one is revenue account, profit and loss account, and balance sheet. In the revenue account, we will see the pro forma specimen of revenue account. In the first one is the revenue account. Premium earned is number schedule 1. Under that premium, insurance sheeted, reinsurance accepted, and all those things we have to write it one by one. Then income from investments, any dividend or profit on sale or redemption of investments, or a loss on sale or redemption of any investments. Then transfer gain on revaluation or changes in fair value, everything comes under the income from investments. That is comes under the premium earned schedule 1. Then schedule number 2 is commission and operating expenses. Whatever the commission has to be paid by the insurance company, that all comes under the heading of schedule 2. Then operating expenses, it is for efficient running of the business, they have to, whatever the expenses they have to maintain, they have to pay it, all comes under the operating expenses. Then next one is the specimen of profit and loss account. The amount received, amount transferred from the policyholders, whatever it is. Then income from investments, whatever the income income from investment is available, we have to add it and we can get the total value of A, total A. Then after that, expenses other than those are directly related to the insurance business. That is bad debts written off, provisions for the value of investments, then provision for doubtful debts and others. If any expenses is there, if you have to write it one by one, we have to total it as, and it is named as total P. Then after that, total revenue minus expenses, you can get it a profit or loss before tax. You can get it the amount of profit before loss, profit or loss before tax. Then provision for taxation, whatever the taxation amount is available, you have to deduct it. Then after, you can get it as a profit or loss after tax. Okay. Then schedule one is as per the schedule only, we have to prepare the financial statements. First one is schedule one is premium, premium received. Then schedule two is commission expenses. Then next one is schedule three. It is an operating expenses related to the insurance business. Then next one is schedule four, comes under the benefits paid, whichever claims in the insurance companies, they have to benefits paid to the insurance, and that is insurance claim, that is claim by death or claim by maturity, annuities or other benefits, whatever it may be. Everything comes under the benefits paid. The next one is insurance commissions. Their commission, whatever they have to paid in direct or reinsurance accepted, or if any reinsurance period is there, you have to deduct it from the commissions paid. Then next one is schedule four, operating expenses. It is any the travel expenses, training, auditor fee, advertisement, likewise whatever the operating for efficient run of the running the company for the purpose, whatever the expenses they are going to spend in the certain period, everything they have to list down and they have to total it under the heading of operating expenses. Then schedule five is comes under schedule five is share capital. It is authorized capital issued, subscribed, called up. Then any uncalled money is there or any forfeited shares is there, means you have to detect and add simultaneously one by one. Then schedule six is reserves and surplus. Under the heading of reserves and surplus, it is capital reserve, capital redemption reserve, share premium, general reserve, balance of profit in the profit and loss account is already given. All those items has to be listed one by one, because it is a shareholder, all are concerned as the shareholders fund. Then schedule seven is borrowings. Any the company, insurance company is financially they have to borrow from anybody in the form of debentures, through banks or any financial institutions, and any borrowings is that they have to list down one by one. Then schedule 8 is investments. That is it comes under both the short-term and long-term investments, whatever the insurance company has to made investment to the other avenues. Then schedule 9 it is schedule 9 is loan. Under schedule 9, first one is secured loan, unsecured loan. Then it is comes under central government or state government or banks or financial institutions. Then performance-wise classifications, loans classified as standard, then non-standard loans as per the provisions, then maturity-based classifications. All those things comes under the heading of loans. Then next one is schedule 10, fixed assets. Fixed assets, it is first you have to write it as first goodwill is an intangible. Then tangible assets like freehold land, leasehold property, buildings, furniture, all tangible assets comes under the it is the initial value is named as gross block. Gross block is before deducting the depreciation is called as the gross block. After from the gross block itself, we have to deduct the depreciation from the gross block. After deducting the depreciation, we can get the final amount as net block. Okay, then the total we have to the final amount only we have to take, taken into the balance sheet. Then it is schedule 11, cash and bank balances. Cash deposited in current account or deposit account, savings account, like this, whatever the different kinds of accounts maintained by the insurance company. But any cash in hand, cash at bank, everything has to be mentioned here. Then schedule 12, advances and other assets. Reserve deposits with any seeding companies, then application money from investments, prepayments and advances to the directors. Anything, any advances related advances, they have to advance money they have paid to the outsiders, or they have to Any other assets, likewise, if anything is there, everything comes under the heading of advances and other assets. Then Schedule 13, it comes under current liabilities. With it is age and balance. That is within 1 year, the company is going to pay the premium received in advance, or the uncollected premium, sundry creditors, claims outstanding. Likewise, everything comes under the current liabilities. Then Schedule 14 comes. It shows the provisions. Reserve for unexpired risk, for taxation purpose, for proposed dividend distribution purpose. Then dividend distribution tax, if anything is there. Likewise, we have everything comes under the Schedule 14 provisions. Then Schedule 15 miscellaneous expenses. Discount allowed on issue to the shareholders. Likewise, any other expenses is made by the company. Everything has to be comes under the miscellaneous expenditure. Okay, students. Then we will see the remaining thing we will see in the next class.